Sense is run by a bunch of investment bankers, and their modus operandi.
Hello, I'm Fernando Luque, editor for Morningstar for Spain, and I'm joined today by Simonpickard, manager of the Carmignac Emerging Patrimoine. Thank you for being here, Simon.
Thank you for having me.
My first question is about the asset allocation of the fund. How much are you investing in equities versus bonds? Are you overweight or are you underweight in equities, and why?
Sure. I mean, just so that you understand the structure of the fund, this is a fund that can have a maximum of 50% in equities and a minimum of 50% in bonds. If you look at where we are today, we're clearly underweight equities and overweight bonds. So today we have about 30% of the portfolio invested in equities, 70% in bonds. But our actual exposure to equities is even lower than that, because we use a derivative overlay to reduce even further our equity exposure, which means that we're shorting equity index futures as well as having a lower position in equities. So if you take that into account as well, our actual equity exposure today is around about 16-17%.
So you're very cautious.
Yeah, if you think of that in a range of 0 to 50, we're certainly towards the cautious end of our kind of range. And I think clearly, whilst we remain concerned about the Eurozone, whilst we remain concerned about the US slowing and about China slowing, I think we're likely to continue to run quite a defensive equity portfolio.
If one looks at the last 5 years, one can say, okay, emerging markets have been more profitable than developing markets. But if we look at the risk or the volatility, one can see that the volatility of the emerging markets have been really much higher than the developed markets. Even if the uncertainty is located into the developed markets, and especially into Europe, how do you explain this?
Yeah, it's I mean, actually, I mean, you've said look back 5 years, but I mean, if you look back 10 to 15 years, I think one of the frustrating things about investing in emerging markets is that they haven't provided you protection in these difficult periods. So you look back at the tech bubble in 2000, you look back at Lehman's in 2008, and obviously the European crisis now. On each of those occasions, emerging markets have actually underperformed, even though the problems were in developed markets. And that's not to say that over the long term, as you said, you've had massive outperformance from emerging markets over the last 10 years, but you haven't escaped the sort of downfall in developed markets. And I think there are a couple of reasons for that. I think most importantly, I mean, emerging markets remain an asset class which is very dominated by global investors, i.e. by investors who are taking money from the Eurozone, from the US, and investing in emerging markets. And clearly at the first sign of trouble, what they do is repatriate money. And we're seeing that not just in terms of investors like us, we're also, of course, this time particularly seeing the European banking system withdraw back to Europe. And I think that something that not everyone was aware of before this crisis is that, for example, the European banks finance about 75% of global trade, particularly the French banks, actually. And so it's not just investors, it's also banks that are withdrawing, they're stopping credit lines to emerging markets, they're not renewing credit lines to emerging markets. And so you're getting a number of impacts from these kind of developed world investors that are hitting emerging markets. And of course, emerging markets economies do slow down in these kind of periods. I mean, we're seeing slower growth across the emerging world, Brazil, China, India. That doesn't mean that the gap that we've always had between emerging market growth and developed market growth isn't there. I mean, it's an interesting thing that whether in good times or in bad, you've had a sort of 4 to 5% gap in terms of GDP growth between emerging markets and developed markets. And even if this year we're talking about China maybe slowing to 6-7% growth, obviously when we look at our own continent and look at what's happening in Europe, we would all die to have that kind of growth. So I don't think it derails the long-term story, but we always say to our investors that they have to be prepared to suffer these periods where emerging markets do poorly. And this, of course, is exactly what Carmignac Emerging Patrimoine is designed is designed to manage so that you can keep your assets within our fund during these difficult times when we will do everything we can to protect your assets, but we will also be able then to ride the emerging markets as they come out of this kind of crisis period.
Okay. There are more and more voices that say that it's better to invest in emerging markets through European companies or American companies that are highly exposed to those markets. What is your view on this point?
I have a lot of sympathy for that, and I think if you look at our global funds, so Carmignac Investissement, Carmignac Patrimoine, we do have a lot of investments in those kind of companies. So we own LVMH, we own Richemont, we own Yum brands and stocks like that, which have a lot of exposure to the emerging market consumer. I do think, however, that you've got to remember that you're only getting, in most of those cases, 50 to 55% exposure if you look at a Nestlé or a Richemont or some of these. So if you want full emerging market exposure, we still do think that it's interesting to buy the emerging market consumer where he is. And actually, with some of the with some of the falls in emerging markets that you've seen over the last couple of years, quite a few of those consumer stocks now are on reasonable valuations. I think, though, that the reason why a lot of people like these developed market companies is because of the corporate governance, because obviously you're getting first world corporate governance, developed world corporate governance, and where we can, even within our emerging market funds, we pay a lot of attention to corporate governance. We pay a lot of attention to make sure that the interests of the majority shareholders are aligned with ours, and that's why you'll often see in our fund us owning the sort of subsidiaries of multinational companies. So, for example, in China, we're involved in one of the supermarkets that Auchan of France is a shareholder of. Similar sort of thing in parts of Brazil, where we're again in a company like Ambev, which is a true multinational. So, I think that if you are careful and you pick your corporate governance, and obviously you pay attention to valuation, I think you still can get a lot of value out of emerging market consumer stocks. But for the global investor, I think it makes a lot of sense to look outside and to look at some of the stocks that you mentioned.
Okay, let's finish with the fixed income part of the portfolio, which is a big part.
Yes.
How are you positioned in terms of fixed income, and including currencies?
Well, I think the fixed income world is also a very varied world now in emerging markets. You can buy, of course, sovereign debt, both dollar denominated and local currency, but then of course you can also buy corporate debt. There's an increasing amount of corporate debt in emerging markets. Our choice today in a defensive environment is to buy local currency denominated sovereign debt, because we feel that clearly that's where the credit risk is the lowest. We've also wanted over the last 6 to 9 months to play the kind of disinflationary trend that we've seen in emerging markets over the last few months. And I think the other interest with this kind of fixed income in emerging markets is that you're still getting very high yields compared to the kind of yields that are on offer in the developed world. And obviously in a world where we all know bonds are yielding less than 2%, US treasuries are yielding less than 2%, I think the attraction of being an emerging market fixed income only becomes greater. So as I mentioned, while we're still in defensive mode, we'd far rather concentrate our investments on sovereign debt. But as we start to get more confident that we're through this period of crisis, and we start to feel that emerging markets will come out the other side and start to appreciate, then I think you'll see us within this fund switching into more corporate debt, because we get higher yield. We think we'll get more capital appreciation out of a lot of that corporate debt, but we think it's a bit early to do that now. Now, as for your question on currencies, our long-term view is that for a euro-based investor, there is an enormous amount of traction being in emerging market currencies. We all know the problems of the euro. I think that the problems of the dollar are also very evident. And so I think that for an investor to be able long-term to invest in emerging market currencies is going to be as important a source of returns as the instruments you choose. So you will of course make money out of the equities, out of the dividends, out of the fixed income, but I think you'll still make a lot of money out of the currency appreciation, particularly if you're a euro investor. Having said that, we are aware that in moments of stress, many emerging market currencies do badly in the short term, notwithstanding their long-term fundamentals. And so during this kind of period where we think there is a lack of risk appetite in the market, what we've done is hedge out some of the more vulnerable currencies. And those tend to be currencies with big current account deficits that do need to rely on external funding. So we've hedged out our position in the Indian rupee, in a lot of the countries of Eastern Europe, Middle East and Africa, so the Russian ruble, the South African rand, the Turkish lira. One of the difficulties of hedging out emerging market currencies is that it's very expensive to do because of the interest rates. So in some currencies, so for example, rather than hedging out the Brazilian real, what we've done instead for this fund is to have a long US dollar position, which should act in a more correlated way. And that again has been a very good thing for our investors in euro terms over the last couple of weeks as the dollar has strengthened against the euro. And I think that's again one of the things that has allowed us, if you see the equity markets over the last couple of months have lost more than 10% in emerging markets, Carmignac Emerging Patrimoine actually has remained completely stable over that period. So I think it's a mixture for us of both our management of the currencies, the ability to hedge out our equity risk, which is what we talked about earlier, and I think our management of the fixed income portfolio, which have all enabled us to really ride out these difficult moments in emerging markets, and I think have left our investors able to retain their capital and to sort of be able to participate in the upleg, which we sure will come in emerging markets.
Okay, Simon, thank you very much for your views on emerging markets.
Not at all.
Simon.
Thank you very much for having me.
Run by investment bankers, and Morningstar's tools can help make